If we used a little bit more leverage throughout, we'd have 3 times as much now.
In a recent revelation that sent shockwaves through the financial landscape, Munger uncovered a perspective that challenges the very essence of Warren Buffett's approach. Who is one of the richest investors on earth? The famous Warren Buffett's longtime partner and co-worker Charlie Munger said,
Warren still cares more about the safety of his Berkshire shareholders than he cares about anything else.
Knowing that these two financial giants have worked together and been successful for decades makes Munger's words even more meaningful. There is more to Warren Buffett and Charlie Munger than just their names. They are the backbone of the huge business company Berkshire Hathaway Inc. But their trip didn't start in corporate boardrooms. It started with 2 regular people from Omaha, Nebraska, who had a lot in common. They met by chance thanks to a well-known local doctor named Dr. Edwin Davis, who set the stage for a legendary relationship. In 1957, Buffett's life changed after he had a talk with Dr. Davis. Davis said that Buffett reminded him of someone named Charlie Munger when he talked about how much he trusted Buffett's business sense. When asked about Munger, Buffett only knew his name. Well, I don't know who Charlie Munger is, but I like him. Dr. Davis and his wife Dorothy really wanted to bring these 2 like-minded people together, and in 1959, their hard work paid off. The scene was a dinner in Omaha, not long after Munger had moved back there after his father died. The meeting was exciting in every way. Munger's contagious laughs and sharp wit struck a chord with Buffett right away. They both saw something in the other that reflected their own spirit and intelligence. This was the start of a relationship that would change the world of investing forever. By that time, Munger had already made a name for himself as a smart lawyer and money manager. He was looking for something more difficult and satisfying, though. His work with Buffett and Berkshire Hathaway turned out to be the right way for Munger to use his skills in a setting that shared his values and goals. When Munger joined Berkshire Hathaway for real in the middle of the 1970s, it was the start of a new age. After he finished his work at Wheeler, Munger & Company, he quickly rose through the ranks at Berkshire, becoming vice chairman in 1978, a post he is still proud to hold today. In a June 30, 2021 chat with CNBC, Buffett talked about how he realized right away at their first dinner meeting that they would become friends for life. Munger was not only going to be a part of his life, he was going to be an essential part of it. Fun, money, and knowledge, that's what we were meant to have together, Buffett once said about his relationship with Munger. Their friendship wasn't just about making money, it was about giving each other ideas, making each other laugh, and promising to be better people because of their bond. That Munger is very smart, has a great sense of humor, and can put together complicated ideas into simple lines are some of the qualities that Buffett often praises about Munger. Buffett made this respect clear. Charlie and I resonate on the same wavelength. For me, it takes a page to explain a thought. He only needs one line. Munger also holds Buffett in high regard. He often talks about how they both like to laugh and roll their eyes at life's serious moments. On a recent podcast, Munger talked about his investment theory and life lessons. He stressed the importance of being patient, thinking logically, and learning from the mistakes of others. Their approach to money, focusing on long-term investments and sticking with them through market changes, has made them not only financial legends but also visionaries. Aside from money, though, their friendship is a shining example of how 2 people with similar values and a love for the same thing can reach great heights together. Sounds like the dream team, right? After all, these 2 have generated more money than some countries could ever hope to generate. But not all is well in paradise. Munger, in a bold way, criticizes the Oracle of Omaha for placing the safeguarding of Berkshire shareholders above all else. What adds a captivating twist to the narrative is Munger's bold assertion that had Buffett embraced more risks, our reserves could have grown manifolds. Munger says,
If we used a little bit more leverage throughout, we'd have 3 times as much now. Warren still cares more about the safety of his Berkshire shareholders than he cares about anything else.
So if the 2 were in so much harmony, then why would such a difference in opinion arise? Well, one possible explanation could be something that the two experienced back in the 70s. A little-known part of the history of investing is the story of Rick Guerin, the third musketeer in the Buffett Munger tale.
He was one of my closest friends for many decades, and he was very good company and a splendid gentleman, and of course, we accomplished quite a bit working together. Rick was part of the group which consisted of Warren Buffett, Rick Guerin, and Charlie Munger.
Along with the famous pair, he was in charge of his own fund called Pacific Partners. But the most important thing he did was work with Munger and Buffett to get a majority stake in Blue Chip Stamps. Blue Chip Stamps, a small business that was at the center of the early loyalty points trend, sold trading stamps to stores like grocery stores. Customers could use these stamps to get different things, depending on how many they bought. It was an idea that was ahead of its time and helped make reward programs what they are today. Getting Blue Chip Stamps was just the start for the three of them. They cleverly used the company's float or extra cash between when stamps are issued and when they're redeemed to fund even bigger projects. Getting See's Candy for a cool $25 million in 1972 was the crown prize of these deals. In an important moment, Munger, Buffett, and Guerin all picked Chuck Huggins to be CEO of See's Candy. It was Buffett who brought attention to Guerin in his famous 1984 piece, Super Investors of Graham and Doddsville. He praised a group of great value investors, including Guerin, whose Pacific Partners Limited did incredible things, beating the S&P 500 for 19 years. But after See's Candy was bought, Guerin's road became different from Buffett and Munger's. The team of three was cut down to the famous pair of Buffett and Munger. But the question still stands, why is Rick Guerin a blip in history? Even though Guerin had an amazing 22,200% gain from 1965 to 1983, his name doesn't get as much attention as Buffett's or Munger's. The mystery grows because Buffett's essay doesn't say anything about why they broke up after their great businesses with Blue Chip Stamps and See's Candy. By the 1980s, Guerin was less well known and was no longer working with Buffett and Munger. In 2008, a smart money manager named Monish Pabrai took charge of Pabrai Investment Funds. It took Pabrai over $650,000 on eBay to win a lunch with Warren Buffett, which was a big deal. During this amazing meal, Pabrai brought up Rick Guerin. In a chat with the Motley Fool in 2013, Pabrai talked about the meeting and shared Buffett's wise response. "I just met Rick, but he didn't seem to be into investing anymore. I was interested, so I asked Warren where Rick was and what his story was. Warren's answer told us a lot. He said he stayed in touch with Rick and told him that Charlie and he were always sure they would be rich one day, but they never rushed it. Rick, who was just as smart, wanted it to happen faster. The market crash of 1973 and 1974 was terrible, and Rick had to deal with constant margin calls because he had borrowed money to invest. He had no choice but to let Warren buy his Berkshire shares for just $40 each. The years in question had a big effect on Guerin's Pacific Partners success chart. The fund dropped a crazy low, 42% in 1973, and another 34% in 1974. For a total drop of almost 62%. On the other hand, the S&P 500 fell more than 37% during the same time period. This terrible drop in Guerin's fund probably hurt not only the value of his investments, but also the trust of his partners and investors, like Buffett and Munger. Today, each share would be worth $550,000. One important thing that Buffett told Pabrai about trading is that you should only sell your holdings when you want to, not when you have to, because of money problems. Guerin's story is a warning about the dangers of taking on too much risk. Using leverage, even though Guerin had great long-term results, he disappeared from the business world. His great promise was overshadowed by what Buffett called impatience, which kept him from joining the great investors of history. Due to margin calls, Guerin had to sell his Berkshire Hathaway stocks for a very small part of their value. This was a stark example of how borrowing money can go wrong, even for the smartest investors. Warren Buffett and Charlie Munger both follow a basic investment theory based on Benjamin Graham's teachings. However, their approaches are not exactly the same. Well, Charlie Munger had a keen understanding of the importance of investing in top-notch businesses early on. His philosophy boiled down to the idea that it's smarter to get a really good business for a fair price than to settle for a mediocre one at a lower cost. Munger seemed to get this concept before Warren Buffett did. While Buffett initially found success with a more traditional approach, Munger was ahead of the game in appreciating the value of outstanding businesses. It's interesting to note that both of them are careful with money and don't like to overpay for investments. However, Munger, with his sharp eye for exceptional businesses, spotted their true value earlier than Buffett. This difference in their viewpoints adds a fascinating twist to their successful investment journey together. Their investment paths took separate turns, evident in situations like Costco. Charlie Munger was all in for a much bigger investment in Costco, but Warren Buffett hesitated, thinking it was too pricey. Munger believed that certain chances are worth the extra cost, a viewpoint not entirely shared by Buffett. Another point of disagreement popped up with BYD. Munger compared Chung Fu Wang to both Thomas Edison and Henry Ford, pushing Buffett to invest. However, Buffett wasn't convinced, showing a clear gap in how they saw investment opportunities. While these differences weren't common, they shine a light on the intricate dynamics between two brilliant minds navigating the tricky world of investments. But why does Warren Buffett place such a high emphasis on safety in his investments?
The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule, and that's all the rules there are.
Okay, so Warren Buffett is admired not only for his impressive returns, but also for his disciplined approach to managing risk. Buffett understands that protecting capital is just as important as making profits, and his careful approach to risk has been a key factor in his long-lasting success. And the first and foremost important step in handling risk or losing money is to really understand the businesses you invest in. This means doing thorough research to learn about how a company works, its competition, and the potential challenges it might face. Knowing all this helps you make smart decisions and accurately judge the risks involved. For everyday investors, it means doing your homework before putting money into a company. Check out their financials, understand the industry they're in, and spot any possible issues that could affect how well they do. Following Buffett's advice on knowing your stuff can be a practical guide for anyone trying to navigate the sometimes tricky world of investing. Munger also thinks it's very important to understand cognitive errors and psychology when investing, and he supports a multidisciplinary approach and mental models. Another area where they differ is how they feel about technology and industries that change quickly. Buffett has always been hesitant to invest in tech companies, choosing business models that are stable and easy to understand. Munger isn't a huge fan of technology, but he is more willing to invest in companies in fields that are changing quickly, as long as they keep their strong economic moats. Their different ways of doing things have helped their partnership work well. Munger's readiness to pay more for quality and focus on psychological insights is balanced by Buffett's desire for undervalued companies and a cautious approach to new industries. Together, these traits make Berkshire Hathaway's investment strategy dynamic and strong. I hope you enjoyed this video. Do not forget to subscribe to our channel and hit the bell icon on your way out. See you all next time.